printing money. Inflation looks like simple price increases. In practice, it is a slow transfer of buying power. Wages rise later than prices. Savings in cash lose ground each month. When governments or central banks create more money than the economy's output, more currency chases the same goods. This pushes prices up. In earlier centuries, rulers shaved coins and mixed in base metals. Today, the process is digital and less visible. The effect is similar. Groceries, rent, and transport cost more than last year, while paychecks stretch less. Households respond by saving less and borrowing more. Those with assets such as homes and stocks may keep up because these assets tend to follow prices. Those without assets fall behind. Inflation also reduces the real value of government debt. Each year of higher prices makes old promises cheaper to repay in weaker money. But when quiet erosion is not enough, the next tactic compels lending, not saving. Forced loans. Forced loans appear in many forms. In medieval Venice, wealthy citizens had to buy state bonds called prestiti. In 17th century England, the crown raised funds through a forced loan without Parliament's consent. These were not voluntary investments. They were orders backed by law. Modern versions are softer but similar. Banks and pensions must hold large amounts of government bonds by regulation. Interest rate caps, reserve rules, and capital requirements create captive buyers. This keeps government borrowing costs low. It also means savers earn yields that can sit below inflation. The loss is quiet but continuous. Money is parked where the state needs it most. Liquidity flows to public debt first, private uses second. The label changes across eras. The mechanism stays the same. If compelled lending builds the habit, the next step makes permanent debt a feature, not a temporary fix. National debt. In 1694, England faced war and needed money fast. A group of financiers raised £1.2 million and lent it to the crown. In return, they gained a charter. That charter created the Bank of England. It also created a template. The state would borrow from a central institution. The institution would manage money, payments, and government debt. Debt would not be cleared at the next harvest or the next peace treaty. It would roll over and grow. Government bonds would become the safest asset in the land. Banks would hold them. Investors would trade them. Budgets would include interest as a routine line item. This system financed wars, canals, railways, and later social programs. It also normalized something new, a permanent national debt attached to a permanent central bank. While this framework made funding reliable, the next pattern shows how gaps between taxes and spending turn into a steady transfer. Deficit spending. A deficit happens when a national government spends more than it collects in taxes. The difference between spending and tax revenues is covered by borrowing. Borrowing is done by the Treasury selling government bonds. A bond is a formal written acknowledgement of a debt between parties. It promises interest payments along the way and full repayment on a set date. The promise is backed by the government's ability to tax and by its control over its currency. Bonds are acquired by banks, pension funds, insurance companies, mutual funds, foreign central banks, and wealthy households. They buy because the bonds are considered safe and easy to trade. The interests are paid by future budgets, and those budgets are funded by taxpayers. So, over time, money flows from the broad base of taxpayers to the narrower group holding bonds. If most bonds are held by higher wealth investors and large institutions, interest income concentrates there. Even when borrowed funds build roads, schools, or hospitals, the interest stream keeps running. As the debt grows, interest becomes one of the largest line items in the budget. The transfer is slow, steady, and built into the system. But when heavy borrowing meets a financial shock, the next playbook shifts private losses onto the public balance sheet. Bailouts. A bailout is emergency help for a failing financial firm. It happens when a big bank or insurer is about to collapse and pull others down with it. The goal is to stop a chain reaction. Governments and central banks provide guarantees, emergency loans, capital injections, or buy bad assets. They also arrange forced mergers. Money and promises flow in fast. The firm's creditors and customers are the one that bailouts aim to save. Depositors keep access to cash. Bondholders get paid in full or close to it. Shareholders may lose a lot, but the institution survives. The public sector pays the price, first with its balance sheet and later with taxes or borrowing. Even if much is repaid, the risk was carried by the state during the storm. That support pushes private losses onto the public ledger. Bailouts are controversial because in good years, profits stay with owners and executives, whereas in bad years, extreme losses are softened by public support. This is called moral hazard. It means rules and expectations can make future risk-taking larger. The system is stabilized, but incentives shift. If bailouts patch sudden holes, the next stress builds slowly inside long-term promises that are hard to keep. Pensions. Public pensions often run on a pay-as-you-go design. Today's workers finance today's retirees. It's like a legal nationwide Ponzi scheme. It works well when populations are young and growing. It strains when birth rates fall and life expectancy rises. There are fewer workers per retiree and more years of benefits. When costs outrun contributions, adjustments follow. Governments raise contribution rates. They lift retirement ages. They slow cost of living increases. In some cases, they change benefit formulas or indexation rules. Each step spreads the pain over time. The underlying challenge remains simple. A smaller base is asked to support a larger top. The earlier the reform, the smoother the path. The later the action, the sharper the cuts. It is a political problem wrapped around a demographic fact. While pensions wrestle with promises, the next tool changed markets in a few keystrokes by having the central bank buy bonds at scale. Quantitative easing. Quantitative easing, or QE, is a central bank buying government bonds and similar assets with newly created money. The goal is to push down long-term interest rates. Cheaper borrowing supports spending and jobs, but there is a side effect. When yields fall, asset prices tend to rise. Bonds gain, stocks often gain, housing can gain as mortgage rates drop. Households with assets see their net worth lift. Households without assets do not. The gap widens. Quantitative easing is not designed to boost inequality. It is designed to prevent deep recessions. Yet the channels that make it effective also raise values for those who already own. Distribution depends on who holds what. That is why balance sheets matter as much as paychecks. If asset prices can rise without a vote, the next method raises tax burdens without a vote, hidden in the mechanics of inflation and thresholds. Stealth taxes. Governments collect money in ways that are not obvious. Indirect taxes like sales taxes and value-added taxes are built into prices. They land hardest on those who spend most of their income. Bracket creep is another quiet tool. When inflation lifts wages, taxpayers shift into higher tax brackets, even if real purchasing power has not improved. If thresholds are not fully indexed to inflation, the tax take rises automatically. Inflation itself acts like a tax on cash. Each month, a fixed paycheck buys less. Savings held in low-interest accounts lose real value. Debt becomes easier to pay back with weaker future money. These effects do not appear in a budget speech. They accumulate silently. They change behavior. They move resources from households to the state without a headline rate hike. But while taxes can be hidden, the next force shapes the rules that set every rate, fee, and exception. Regulatory capture. Regulatory capture happens when an industry gains strong influence over the agency meant to oversee it. The tools are mundane. Expertise lives inside firms, so regulators hire from them. Regulators later leave for jobs in the same firms. Advisory committees draw heavily from industry. Technical language and complex models narrow who can participate. Over time, priorities shift. Rules bend toward incumbents. Barriers to entry rise. Enforcement weakens at the edges. This is not a conspiracy narrative. It is a structural risk wherever expertise is concentrated and stakes are high. The result is predictable. Consumers face higher fees and fewer choices. Taxpayers absorb more tail risks. Innovation moves slower when gatekeepers write the gates. If peacetime rules get shaped this way, the next subject shows how wartime needs to stretch every rule at once. War financing. War finance draws on three levers: raise taxes, sell bonds, and create money. In major conflicts, governments often use all three. Tax campaigns frame higher rates as patriotic duty. Bond drives invite households to lend savings to the cause. Central banks help by keeping interest rates low and ensuring markets function. During big wars, some governments fix rates by policy. This makes borrowing cheaper, but risks inflation later. After the fighting, debts remain. Some are inflated away as prices rise. Some are rolled over for decades. Some are paid down with primary budget surpluses. The method chosen shapes the path of living costs, wages, and savings for a generation. War finance is not a footnote. It is a turning point in a nation's financial architecture. But while war is openly urgent, the final tactic works in peacetime by hiding costs inside complexity. Weaponized complexity. Complexity is a tool. Long fee schedules, dense disclosures, and layered products make true costs hard to see. Overdraft programs hinge on posting order. Credit cards blend teaser rates, penalty rates, and multiple fees. Mortgages and small print add-ons bundle insurance, servicing charges, and prepayment traps. In capital markets, intricate structures can hide risks until stress reveals them. Regulators face the same problem. Rulebooks grow thicker each year. Firms hire teams to navigate every footnote. Small players cannot. Consumers with limited time fall back on defaults that may be costly. In many cases, the design is legal and even disclosed. The effect is still real. Money flows from inattention to intention. Simpler rules and simpler products reduce this tax on confusion. Clarity has a price, and so does opacity.